Hello and welcome to another episode of the SwingTrader Status Update. It's Justin Nielsen here, your host, and we are coming to you live on September 9th, 2025 to just go through all things SwingTrader. So this is about the SwingTrader strategy, but also our SwingTrader product and how we've been handling things. This is meant as an educational tool for our subscribers to kind of give you a sense of level of invested, what kind of things you should be invested in, idea generating, and all of that. And to help me walk through it is one of the brains behind SwingTrader, actually the main brain, I'm going to say, Mike Webster, our senior market strategist. How you doing, Mike?
Dude, I'm tired. This market is wearing me out, man. It is seriously wearing me out. The wiggles and wobbles, but hey, that's what we're here for, right?
Exactly. So, we'll get right into it because, this market has been tricky. I mean, we went through kind of, and a lot of people refer to the seasonal summer doldrums, although we had some real power for a good portion of it. I'm going to go ahead and pull up the NASDAQ right here. And certainly if you consider July, that was very strong. August, not too bad, but we had a lot of kind of this back and forth. We started with this big drop on August 1st, our first puncture of the 21-day moving average line. And we talked a lot about this our last episode, how we had been trending so long above the 21-day moving average line, broke that. Very reminiscent of the 1980s precedent. So for those that haven't seen that, Mike Webster has gone into detail on that for both the SwingTrader status update from last time, also the SMT videos that you do every Friday, or most Fridays, I should say. We've been kind of tracking that 1980s precedent, but I guess the one question here is that as much as the NASDAQ has been kind of going through this chop a little bit, if we look at IWM, which is the ETF for the Russell 2000, this is the iShares Russell 2000, there's been some power here, and this might be maybe the time that Lucy doesn't pull the football away. It remains to be seen. So with all that as a background, take it away, Mike, your thoughts.
Sure. Well, the key thing is, let's toggle back to the NASDAQ just for a second. This is still tracing out the 1981, as you mentioned, which would push us past 22,000 if it holds, but not for long. And then there is a correction. So at some point, we're going to throw out that precedent when the precedent breaks. When we had the stalling action on Friday, we were saying, you know what? If this comes in and doesn't go up to fresh highs, we have to drop this precedent, because back in the 1981, we don't have to pull it up. We've gone over that so many times. It went up, pretty much straight up into new highs. And that was the one thing that was a little bit different there. So, that one is still working, but when a precedent isn't perfect and it's like starting to break, just the spirit of it is starting to break because it's going up into new highs, but it's doing it at a much slower pace than it did back then. You just rely on the rest of your indicators because you don't always have a precedent to go off of. So what do? You use things like power trends, distribution, follow-through days. I like to lean heavily on the 21-day and the low versus the 21-day. And that is working really well. We've had 3 tests of the 21-day on the NASDAQ so far, and each one has been successful. The last one was feeling a little bit shaky, frankly. The way we were acting, going into the weekend, just wasn't a fan of that stalling type of action. But it looked a lot better at the close than it did intraday, because let's pull up SPY, for example. Those were looking like some serious downside reversals at highs when they downside reversal at a new high when the market was at a low on that day. And so you have to really be respectful of downside reversals, just like you need to utilize upside reversals. When you have an upside reversal, your expectation is to move higher. So we had an upside reversal earlier in that week because we had that gap down on Tuesday.
And that was on September 2nd.
Kind of a negative. Yeah.
That was on September 2nd. Right.
Yeah, my parents' 58th anniversary. So happy anniversary, guys. So that day was kind of a make it or break it type of day because we could have gone down and tested the 50 day or tested that 619.29. And you always look for key times like that when the market is on the ropes of which way does it go? Does it act stronger or act weaker? And there it acted stronger. So then you had to, kind of press on the gas a little bit wherever it is to be pressed on. And we did some stuff there using that as, that upside reversal as an expectation to move higher. Conversely, if you have a downside reversal, which we were looking like we were going to have last Friday, you have to back away because then your expectation is further weakness. It's not saying that an upside reversal is going to launch and go up 1,000%, and downside reversal you're going to go down 50%. It's just near-term action when you've got your swing trading hat on, that's what this product is about and this show is about. If you're position trading, you don't have to do too much, or sometimes you don't have to do anything at all. The position trading is just holding things for longer periods of time. But when you're trying to catch the wiggles and the wobbles, it's a lot of work, but you have to be more active. And those are the two key days: downside reversals and upside reversals. So the potential downside reversal that we had on Friday, you have to take that seriously. But then the fact that it was able to lift up by the end of the day was very encouraging. In the last couple of days, having some blue days with our low, maintaining that level above your 21-day, very healthy. Now let's toggle over to the IWM, which is where I'm positioned right now.
Well, just real quick before we move over there, I just want to also mention that, again, as ugly as the indexes looked, some of the stocks looked a lot worse. I mean, if I recall, I think we opened up on SwingTrader, we were up like over 2%, maybe 2.5% for the day. And then that was quickly, coming in to, it was still up considerably, a lot of outperformance, over 1% up for the model portfolio, but things were just, again, not nearly as strong as they were at the open. And some things had, really started looking pretty poor by the end of the day. But yeah, go ahead and let's, you know what, before we move on there, I should also mention, just because we're here, one of the trades that we did, kind of a very quick one, to your point, was UPRO. Just again, since you just went over that upside reversal and the downside reversal, that just allowed us to kind of get a very quick little jolt there to the portfolio, the model portfolio, with the UPRO position.
Yeah, that worked out well. And when you look at a trade, you always want to look at your past trades, and the two of us have done that historically, especially with SwingTrader, of reviewing, and when you're off, just going, okay, what did we do wrong? And then when you're on, like, what did you do right to try to do more of that? With this one, with this trade and with every trade, it's not if you made money that defines it as a good trade. This was a good trade because we followed our guidelines of what we do. Upside reversal, you buy. Downside reversal, you sell. And that's what we did. Now, it ended up coming back, so it wasn't a downside reversal, but you act in the moment, but you would do that. I would do that trade over again. Now, there are other trades where you look at it, and even when you make money on it, doesn't mean it's a good trade. You're like, sometimes you just get lucky, and you're like, man, I just got lucky on that. I shouldn't have done that. Or sometimes you get unlucky, and it was a trade that you would do again. So that's just an overriding thing that people should do, is look at your trades, look at the trades over the last month, and be honest with yourself and say, okay, which ones did I get lucky on, unlucky, or good lucky? And then, what rules did I break? And then write some rules around that and just say, okay, when this happens, I'm not going to do that. But it's an ongoing thing that both of us always do. And that's how you improve. And that's how, you're always going to make mistakes, but you try to do fewer of them. And I think that was a, kind of a classic trade for us. Would I have wished that, it would have gone a lot higher? Yeah, but that's not how that played out. So that was just a quick little swing trade, and it worked out. We're looking for a new entry to get back in. We could have put it on today, but it wasn't really clear that the way it closed was very nice, but it wasn't really going up over anything. Yeah, so you could doodle around in there and still be okay. So with our swing trades, what we try to do is have a clear expectation that if we put it on, it should move higher if it's acting right. And this one could, like this is debatable whether to put something on today in that space because, it wasn't clear cut and we'd rather have a little bit more clear cut, but that's,
And I'm just
I was
gonna
happy with that.
I'm just going to walk through real quick. So, as we mentioned, we got the full position start. Sent that alert out to subscribers on September 2nd, and then one of the things we've been doing is going a little bit heavier on the ETF side. And this is a triple leveraged ETF, but we still made this a double position as we got the follow up on that upside reversal. So that kind of allowed us to stretch a little bit on this position, and then we started we trimmed in two pieces right around the same price. I think on that day it closed at 102.38, and I think we were kind of selling a little bit under that, as you mentioned, it looked worse. So as it was coming in, we were selling, and then it closed okay, maybe a little bit less than a point above where we sold it. But again, we did that in two pieces, and it just wasn't getting any oomph at first. So we didn't want to wait until the end of the day heading into the weekend. And we're going to revisit that September 5th because there were some other things that we did there as well. But let's go ahead and continue.
Let's pause for a second and go back to the SPY U Pro thing. So one other point on that is, if we had done that as a single, not a triple, there's a possibility that we would have just kept the position in there.
Right.
And but when you have a triple or even a double leveraged, you really have to be respectful of it. And there's the saying that Bill would say, the quick and the dead. You really have to be quick and hope that it goes higher, that you sell out and it was a bad sell that ends up going higher. But you'd rather sell then wait for it to break that 21-day and then round trip on you. So it's a big part of swing trading, is sometimes you got to just take a bunch of small gains, and your goal is to not have any big losses. You're going to get caught in gap downs, but just trying to incrementally just baby step it up.
Yeah, absolutely. Okay, let's continue the discussion, because unlike maybe what we were looking at for the 1980 precedent, where we just focused on the NASDAQ. If we kind of take a step back and play some 3D chess here, and we look at different indexes as a possible place of rotation, we could see the NASDAQ top, but the money could rotate to some of these other areas. And two of the areas that we've been pushing pretty hard on are the Russell 2000, the small caps, just as a reminder for the macroeconomic side. And I know, cover your ears, Mike, because I know you don't look at the 10-year treasury yield, but the 10-year treasury yield has come in quite a bit, and especially after the jobs report on this last Friday. So with that coming in quite a bit, that does tend to be favorable for your small cap companies. Certainly what we saw for the small caps is during the 2022 rate hiking cycle, Russell 2000 was really suffering, and it just didn't really recover from that rate hike cycle. That it does affect them a little bit harder, because they're the ones that have to borrow a lot of times to grow their companies, or sometimes stay in business. And when your borrowing costs get higher, that's going to affect those smaller companies, as opposed to an Apple or something that is sitting on a whole mountain of cash. It doesn't really have to do the borrowing in the same way. So Mike, taking a look at Russell 2000 and the small caps, what's the potential here? How do you know? Because we've had a lot of false starts here. So far, this is working. And I should mention that I do have a position in TNA, which is a triple leveraged on the Russell 2000. So how do you know that it's working? How long do you give it? And when do you start saying, oh, you know what? I've got to head for the exits?
Good question. And I do have IWM as well as TNA, just various accounts, different ones. So you know it based on your instruments. So with SwingTrader, we use heavily the 21 day. So our low has been now trending above the 21 day for long enough to really feel very confident with it. Your 21 day is above your 50 day, and has been for a significant period of time. So you're a power trend, and you keep an open mind with that. It is that it could go a lot longer than you would think. Like let's just go back to the Qs for a second, or NASDAQ. I'm sorry.
Oh,
so this is So look back at the time where your low had been above your 21 day for only about 10 or so days, and your 21 day had been above your 50 day for about 5 days or so. That was early on in that move, and at that time you'd be thinking, like, you wouldn't think, oh, we're going to go all the way up to 20, near 22,000 in a blink of an eye. But you have that open mind because your instruments are telling you, hey, this is what's happened in the past. When this trend starts, it can last a lot longer than you think. As Livermore would say, it's not your thinking, right? It's your sitting. And so we're kind of doing a little bit of both. Like we're actively trading the uptrends to try to lock things in, but you're staying in a direction of, like if you're driving a car, you're still, going forward at a pretty fast speed. You're just kind of switching lanes a lot the way we do it, versus if you're position trading, you're just kind of going and you're just in the fast lane and just staying there, whether there's an accident in front of you or not. Hopefully that made sense in my head. Not so much as it came out of my mouth. Let's go back to the IWM for a second. And so this feels like it's early on in this move. And let's go to the weekly again and look at how many false starts we've had for last 3, 4, 5 years of every time it looks like it's going to get going, it rolls over for one reason or another. I think people have been conditioned so much that it's like, oh, it's not going to work. Even me, when I was buying it, I was like, oh, this isn't going to work, but I've got to buy it. It looks set up. And so I think that's very good from a contrarian standpoint. I think there's a lot of money on the sidelines, waiting to go in the small caps. Now, that you could say that same thing for international stocks, almost every year for a couple decades of, oh, it's time for them to go, and then they don't go. So you want to always keep an open mind that you could be wrong. So how do you know if you're wrong? Well, use the 21 day. Let's go back to the daily. If we come and we close, materially underneath the 21 day, and then we've got to reevaluate and say, okay, well, was that because there was some news item that came out that was, big enough to warrant that? Or is this just another one of, like, as you say, the Lucy pulling out the football? So right now, this is in a solid trend, and it looks very, very early. And so that's why have a heavy weight here, in trying to kind of trade this as a potential position trade. Now, you never go into, you don't buy something as a position trade in years. You can go into it as a swing trade, and if it's working out, switch to a position trade because you're up on it. So that's how we're looking at this, and we're also using that same thing for the home builders. Now, today was a terrible day for the home builders. You had a stock that,
well, and before we go there, just real quickly, I want to make sure we mention. So right now in SwingTrader, whereas we went with UPro for a very short trade on the triple leverage side, here to as you said, kind of to allow this to be more of a position trade, we're in IWM. Now we've got a larger position size in there. We've allowed that to kind of grow in that way, but we're using the single leveraged. And, I'm looking at the YouTube comments, and some people are commenting about the flaws of using leveraged ETFs because of the way the rebalance happens on a daily basis. And yes, that is true. They are meant to be daily instruments or short-term instruments. But we've sometimes had, really good success using a leveraged instrument for a longer period of time, but it has its limitations, right? When you do the single, you have a lot more ability to handle those fluctuations and a greater chance of treating it as a position trade as opposed to a swing trade.
Yeah, I can't watch the comments during the show, or it creates some feedback on my machine. But they're right.
Yeah.
You for doubles and triples, everyone knows that you have that you have problems with them, but they are a great instrument for short-term trading. If we were planning on doing this and holding it for a long period of time, we wouldn't want to do a double or a triple. You'd want to do the single, but we're doing the single kind of for a few reasons. One, to be able to handle the volatility, because you're going to have times where there's false starts, and we wanted to try to let this one work, but we also want to be able to manage that position. We want to be able to go down to a half size position if it warrants that, and up to a double, or even higher if it warrants that as well. So, going up to a 25% position would probably be where we would max something out. But we want to have that flexibility. It just feels a little bit easier with a single, because the daily moves aren't as dramatic. Obviously, it's 3 times less dramatic with IWM than
Right.
the TNA. It feels a lot better on a day like this on my accounts that I have the IWM, and it not as good in the one that has the TNA. But you pick your instrument, the right tool for whatever the mission is, and for this, we're using the single. There are times where double makes sense, like we did the UGL for the GLD trade recently, and that was a double. Because, and we would have gone with the triple if I was familiar with the UGL. Maybe there's a triple that I just didn't know of off the top of my head, and we went with this one, and we locked it in kind of early because gold tends to, frankly, it was kind of a mistake on my part of locking it in rather than I should have reduced it just to a quarter position. But I know the folks who follow the SwingTrader product have trouble with all of the alerts. So some of the decisions we make are based on, okay, do we want to send 2 alerts or 1? And so we just locked in the game there, and we did that with this as a double instead of going with GLD, because GLD moves slow, so you can take a double there without taking that same risk of, if you're trading a chip stock, there are doubles available for individual chip stocks, and we're not going to do those because there would just be way too much volatility, even if they tracked perfectly.
Yeah. Okay,
so here's the home builder.
Yeah, coming over to the home builders, and by the way, this is a good example of, I do have a position in ITB. I also have the triple leveraged nail, which, I mean, that was down 10% today. That's not something that's easy to stomach. I mean, it's you can do it when you've got a lot of cushion, but it's certainly not something that is it's not something I recommend for your health, for most people.
Yeah, well, I've got both as well, the ITB and I have the XHB, as well as the nail. And the accounts that I have nail was not a fun day today. But you look at it and you go, okay, is this normal and natural or not? So the way I like to do that is, if one of the ways is looking at the 21-day, we're still above it. The next thing is using a 50% retracement. So if you do a 50% retracement from that upside reversal to the high that we had a couple days ago, we're right at that midpoint. No, not that one. The one from the upside reversal. Yeah, that one. Yeah. So, but you could do the other one too. But because that had that drift down in there, that's why I'm looking at more this way. So we're still at that halfway. When you have your 1 day down and it's down this much, your expectation is further weakness. So I'm going into tomorrow saying, okay, home builders probably gonna be down again. I hope they're not, because I'm loaded up to my eyeballs in them personally, but that would be normal and natural. So you want to see, how does it close? If we have weakness in the morning, do you get some sort of upside reversal? But whenever I have one bad day in a stock or an index, I really think it's day one of 2.5 days, meaning the second day is typically bad, and the third day you get some more weakness just to get you shaken out if you haven't been shaken out, then to turn and run up. That's kind of my base case. Hopefully that doesn't happen, but if it does, if we have a bad day tomorrow, we'll probably have to dial that exposure back. But we're doing it with singles with the intent of knowing that we're probably going to have wiggles and wobbles along the way, especially with this group. And you can see the history of it just since it's, from the 87.23, this uptrend that we've had. This is normal and natural. You have a kind of a sharp move up, and then you have a grind lower, and then a sharp move up, and then a grind lower. And the grind lowers, they're taking more time than the sharp move up. So I'm kind of like, we're just mentally, like you always say, you're kind of like tightening up your stomach, getting ready to get punched. So that's why we have, increased our exposure into some other areas today by keeping this one alive. And we'll see if we can make it out alive with this one. It's not going to be easy, and we might have to dial it back, but I still think this is the early innings, of the home builders having a big prolonged move. But that's just an opinion. We will let the stocks dictate what we end up doing.
Now, here again, I think, and Tim said he was taking some profits onto these in strength. And one of the concerns, of course, is we've got a number of things coming up that could affect interest rates, the 10-year Treasury yield, which a lot of mortgages are kind of pegged to that to a degree. So you're looking at the potential with CPI coming out, PPI coming out, the Fed. Will it be 25 basis points? Will it be a larger 50 basis point cut? So certainly some of the more interest rate sensitive areas could get tossed to and fro as investors kind of place their bets on one side or the other. And then, of course, the news itself will come out and the reaction to that. Was it above expectations, below expectations, or like what happened with the jobs report? It was kind of like, oh, look, this is, going to probably make a cut, a sure thing, maybe a 50 basis points. But does that mean that we were maybe in a kind of a recession thing whereas before we didn't really need the cut? Does it make it to where, oh, now we need to cut because we have to stimulate the economy? So when you're facing that kind of potential headwind, you don't know if it's going to be a headwind or a tailwind. How do you kind of position yourself properly?
Well, he's going to do a quarter, right? He's not going to do a half. I spent years studying this guy, and it's not about the data, it's about the person. And I will be shocked if he does a half. I'll be shocked if he does nothing. And I think the market realizes that too. I'm not the only person who studies, him and what he says. I mean, I'm a geek.
And by him, you mean Jerome Powell and the Fed.
Yeah. Jerome Powell. I'll listen to his press conference like 10 times in a row, and I'm not even kidding. And sometimes more, to try to pick up on things. And so that's fine. And if he does more, I'll be surprised and I'll be wrong, but we'll see how the reaction is. But I don't think he wants to spook the market. And a half, I think, could be looked at as a spook. And he doesn't want to go out that way. I think he's wanting to take a measured approach, just based on if you listen to what he says and what he's done over time. So that shouldn't spook the market. Now we're going to have data, and that data can spook the market because if it's something out of the ordinary, but there's no way to game that. You just have to game what the reaction is to it. Sometimes when you get in these environments where people are super hypersensitive to every CPI and PCE and PPI and employment numbers and ADP and the list goes on, that it can push you out of some of the trades that you really want to do. And so while you have to be cognizant of that for the risk that you're taking going into something. You want to do it with your eyes wide open. You don't go into a Fed day or a big news item up to your eyeballs in stock unless you have a clear plan of, and you're kind of making a bet and saying, okay, I think the outcome is going to be this, and you have an exit strategy. So there's a long way of saying, I think he's doing a quarter, and I think this is, the beginning of a long move, but I'm going to listen to whatever the stock says, because that's just opinion. Everything I just said for the last 3-4 minutes is opinion. Everyone has an opinion. Opinions are worthless, but it gives you some context of at least like, what are you thinking? And I'm looking at this. Let's go to NVR. I'm not sure if we've done this one on this. I think we did it on the SMT. Let's go to NVR and just go out to 2002. We'll just be very brief with this because I think we did it on the SMT last week. And let's go to a weekly when you get there. So I'm kind of looking at the potential for a mini version of this. This one, could you point out to where it had its move and it started out of that cup with handle in 2000?
So right here we have our cup
right
with handle.
And then you had this huge move. And at the same time, what was the date of that week?
The breakout?
Yeah,
so
the breakout week.
August 4th, 2000.
Okay, now pull up the NASDAQ and let's point to that same week. And I'm not saying that the NASDAQ is going into the bear market, but I'm saying a mini version of something like this, where something goes out of favor. In this case, it was the .coms blowing up and having to, just go through what is normal and natural after a bubble. And there are some other spaces that were hot. Now this is the extreme case of, looking at the home builders. NVR wasn't the only one. It was pretty much all of them did the same thing. And so I'm saying from a very mini version, let's go back to the current NASDAQ. I don't think we're going into a bear market. We're in we're still in a power trend, even though it's under pressure. We're waiting for it to turn all the way back on again. But this still looks strong. So I'm not saying it's like that, but just to have an extreme example of when one place kind of can just pause, another group can come on. And that's just group rotation. That was an extreme case of it. And so I'm just kind of looking at it saying, okay, that would be very logical. I think the AI thing has years and years and years to go. But it's had a big move. It can pause and base build while other groups come on. Now, it might not be home builders. It might be something completely different. I mean, there's a lot of positive action in the software space after the close with Oracle's numbers. And, maybe the AI thing just keeps on trucking. That's fine, because you can have both things. It doesn't have to be for the home builders to work out or small caps to work out for this one to go flat or roll over. But that's the thesis we're looking at, is that the interest rate environment for mortgages are going to be, at worst staying the same, most likely coming down. And with that, that's the tailwind for this space. Now we got some news out of what was the stock? Was it CNM or something that gapped down today? The water one?
Oh, right. Core and Main.
Yeah, so you have a lot of reaction in the space when, stock is down 25%. And I think they were, saying that residential had been slow. And you never know if that's just a one-off of one company blaming a space, or what has happened in the past versus what is going to happen in the future. Because if they're saying that historically, well, interest rates were up really high, mortgages were really high. So we don't know. This could be the canary in the coal mine, or it could be a one-off. Again, you just follow your instruments. You try to leave your opinions. You have opinions. I clearly have mine, but you just see if your thesis plays out and you don't argue with the market. So if they keep rolling, we'll have to back away and wait for a new entry.
Mm-hmm. I'm going to switch to, and we'll come back to some more charts in a little bit, but I want to switch to some of our typical charts that we share to kind of show where things have been for SwingTrader. So this is just our year to date. You can see that we've been mostly trending above our 21-day moving average line. Did get into a little bit under that recently, but popped above it very nicely last week, and are remaining above it. The 10-day and the 21-day are pretty much the same. So this yellow line here, well, first let me say that the purple is our equity curve for SwingTrader, the model portfolio. And again, a lot of this outperformance that we have over the S&P 500 was because of sitting out, the ugliness of March and April. So not only did we get outperformance with that, we reduced our volatility considerably, reduced our drawdown considerably. And that's one of the benefits of swing trading and what we do on the product. So we've got our equity curve here, the purple line. We've got our yellow line, which is a 10-day of our equity curve, and a 21-day of our equity curve is the blue line. Then we have the S&P 500 as the black line. This is our the green and the bottom is our invested percentage. And so you can see that, we have been getting on margin since we had our April 22nd follow through day. Not all the time. We've had, we kind of get on margin, get up there and then pull back quite a bit and then press on the gas again. So it's a lot of kind of gas easing off the accelerator, sometimes braking when things are looking particularly worrisome. But that's how we've been handling things lately. Any comment on this one?
I just think it's a beautiful thing, that it worked out this well, because we've both been trading for decades and decades, and they don't always look like this. And so you want to reinforce when you do. And let's say this looked horrible. We would want to study and go, okay, well, what did we do wrong so we don't end up like that? When you do something like this, that if you understand this chart, you know how good it is. Not that we're, doubling what the S&P is that we're doing it with dramatically less volatility and risk. And you can just see that based on the equity curve and our moving averages. And so I think what people should learn from that, and what I'm learning from that, is to continue. It's feedback. You're always looking for positive and negative feedback. It's feedback from the market telling you obey your moving averages of your equity curve. So with swing trading, we've got a 10 and a 21 day. If you're position trading, I'd put a 21 and a 50 day and use that as a check to yourself. You could be super bullish and have a thesis on something, but if your equity curve is underneath those moving averages, well, you need to dial those back because you're wrong. It's just telling you, okay, you're wrong. It's okay. You're wrong. We're all wrong a lot in the market. And so you just want to then go back to your instruments and say, okay, what is the most important thing? For us, the most important thing is our equity curve, because with SwingTrader, the product, we are trying to model out a portfolio of to teach people a style, not the only style. It's not the only style I trade, but a style of trading that actually, it's a lot of activity. So it's a lot of work. We're doing that work for you, but you have to enter the orders if you're following along. But it is a lot of work. It is what it is. But the upside is very limited downside. I mean, look at that. We had a bear market and really a crash, in my opinion, and we flatlined, and stayed up by just following our rules. Is it always going to be this good? No. Can it be better? Yes. And every day I'm like, should have done this, should have done that, shouldn't have done this. And that's how you need to be. If you ever think you're doing everything right, man, you are going to get your head handed to you. So what do I not like about this? That dip below the 21 day and that we had like a week ago, and just looking at that, and we were really at the brink of it turning ugly. So excuse me. So you just have to always be careful and find your instruments that work for you and trust them.
I want to just address a couple questions that I've seen in the YouTube. the adjusted the adjusted exit price is something that does confuse people a lot, and so people are kind of asking, does this equity curve go from the entry, the adjusted exit price? The adjusted exit price is only a way to kind of communicate for the past trades. The reality is we are treating this as a portfolio, a model portfolio. So for every entry, there's a share amount that I put in the Excel, and for every exit, if we're trimming, then we're trimming whatever portion we say. If it's, we had a full position and we're trimming half, well, I'm taking half the shares off. So everything is based on kind of a model portfolio. Where the adjustments come is, a full position for us is 10%. And so what I do is when we have a double position size, well, I want the past trade percentage to reflect that, whether it's good or bad, right? You have to do it for both, but it should reflect that, we went heavy here. And if it worked, we should get rewarded for it. And if it didn't work, we should get punished for it. And it should show up there. Eventually, we're hoping to do a little bit more detail here, maybe some extra columns that'll make that clearer. But for now, I put in we put in, because Julia's helping me out. We put in the past in the trade setup what our exit price was, and then that adjustment to show what the gain loss percentage is. So that's the way we're doing that, just for people that are kind of curious about that. And on the flip side, there are situations where, like, we've been using half positions for our individual stocks for a while. That means, hey, we're not quite ready to take that full risk, and so when it works, it means we only get half the credit for it. We only get partial credit. But when it doesn't work, well, we're only going to take half the hit, because again, we're trying to adjust for what's happening to the portfolio. And so to that end, let's talk a little bit about the portfolio.
Can I just add something on there, because I think it was a very fair question of the group, because I do know the way we have the SwingTrader, there's room for improvement there on the messaging, and something that we both want to do and make changes as we have the programming time to do so. But the equity curve, the percent year to date and all that stuff, that is deadly accurate to whatever you see. So if we put a trade on and it's a quarter position, that translates into the 2.5% position of this mock portfolio. If it's a half, it's a 5%. If it's a full, it's 10%. If it's a double, like we have, that's a 20%. So like what you were saying, what we do with the adjusted is just to be able to look at things based on the risks that we're taking. So if we're taking a double like we are with the IWM and it works out, we should get double credit. If we with that line item, not with the equity curve. The equity curve is just how many shares that we're buying in this mock portfolio. But if we only take a quarter, so a 2.5% position, we should be treated accordingly, for better or worse, if it's a great trade. So if we've got, like A-Lab on right now, and it's a half, well, that kills me, because it's only whatever our gain is going to be cut in half. So if we end up being up 20% on the trade, since it's a half position, it's only going to register as 10%. But that's the fair way of doing it. So it's deadly accurate. You spend so much time doing this, and I couldn't do it without you, because I wouldn't know what to do. I just pick the stocks, you do all the hard work. And so we just need to find a better way of messaging it. But
communicating, right? Exactly. Because again, we know that it does cause confusion, and that's why we try and clear it up with these things. I should also mention real quick that on September 18th, for those that are maybe a little bit newer, we are going to be going through a little bit more of a beginner's methodology of swing trading, kind of a little bit more big picture, a little bit of what we're doing on the product. So we're going to have a webinar after the close on Thursday, September 18th. So that's coming up. And for those of you that have been with us for a while, it might not be something that you necessarily get a whole lot out of it, but sometimes you find just one little thing that you learn, and that helps. That helps improve you just incrementally. And sometimes those incremental changes can really add up to something special.
I would
Mike, I want to talk.
absolutely watch that one, so, just put it on your calendar.
Yeah. And it will be archived. So if you're not available right after the close, it will be archived, but we will be taking questions during that. Yeah, so join us if you can, or certainly watch the archives. I want to talk a little bit, and for those that missed it, Mike Webster was on the Investing with IBD podcast a couple months ago, and we did a real deep dive on this whole portfolio ATR idea. And so again, we're using average true range. That's what ATR stands for. And when you look at an ATR, you say, okay, how much does this move on a daily basis? We use a 21-day average of the ATR. And what we do is that kind of tells us about the individual stocks that we're getting into. But because we're treating this as a model portfolio, everything has a weight, right? So as Mike said, a full position is going to start out at a 10% weight. So if it's a very volatile stock with a high ATR, that's going to add more risk to our portfolio. On the other hand, if it's a SPY ETF, well, guess what? The ATR on that is below 1. And so it's going to be a very different prospect holding that, and the risk that puts on to the portfolio. So this is that same chart in terms of the purple equity curve, what the S&P 500 has been doing, but this also shows our portfolio ATR, which is simply for all of the positions, the weight times the ATR, and you add that all up. It's a sum product, and it tells you where you're at. Now, when you have a large cash position, what is the ATR on cash? That's a big fat 0. So that basically, takes away that risk, right? And we're not going to talk about inflation risk and all of that, but just in terms of your numbers. So this is where the portfolio ATR has been, and you can see we got really high up there. What's interesting is that in this period here, we actually had some periods. I'm just going to point out to this peak right here. So this peak right here, we were at 125% invested, at this peak. Now over here, we were 135% invested. So we were more on margin, but our portfolio ATR was lower. How is that possible? We had more ETFs, they had lower ATRs, and so that's what was going on there. Now, we were really pushing it on September 4th, right ahead of the jobs report. So maybe talk a little bit about that, Mike, how we had the chips to play. We had the September 2nd upside reversal. So we had a number of things that were going for us that kind of allowed us to push those chips in at that moment.
Well, things were set up, and it kind of goes back to my point before of you're aware of the risk events that are happening, like a big jobs report, which it was. But you also you put your thinking hat on and go, okay, well, if it does this, what's most likely? If it does the other thing, what's most likely to manage your risk? And the risk was, in my opinion, was on our side based on, without getting into the weeds of what the numbers would translate into from what the Fed was going to have to do. And it was pretty much the Fed was going to have to start cutting, even if they were good numbers, then it would have been a one-off, and so it was just lining up to take the right amount of risk. Plus we had that upside reversal from before, which told you that the market was willing to, the market knew that event was there, and then knew that the Fed was, next week, and, not next week, but, the 17th. And it was positioned in a way where it had that upside reversal at that breaking point. And that told you, it's like a poker game. You're looking for tells in the market, and the market told you it was positioned fine there. Now, what was weird was that downside reversal that was starting to happen, and I was caught off guard from that because I didn't think that should have happened. But again, you don't argue. You're like, I was foreseeing the 1980 where we were going to just blast through, and instead we started stalling there. And so that's why we adjusted on that day. and we locked in a bunch of things and started, backing it off, but not backing it off too much, because our thesis of the small caps and related doing well was still intact. So we didn't have to, over adjust. And you could see that it's kind of like an accelerator, what's, this portfolio ATR. And so we've come off, but we haven't slammed on the brakes. Slamming on the brakes would be, under 2. At 2 is kind of like my baseline that I look at and say, okay, well, all things being equal, 2 is normal. Anything above that, you're taking on more risk. Anything below that, you're playing defense. And there's a time to play defense, as you see, and there's time to play offense. And so I would really highly suggest that folks go back and watch all of your podcasts, but that one in particular, so you understand how to build it yourself and do this, whether you're regardless if you're swing trading or position trading or doing a combination. Create this in there so you're taking, you are well aware of the amount of risk you're taking. Sometimes you can only be 50% invested, but you're taking on way more risk than someone that's 150% invested. Depends on what merchandise you're in. That leaves out, and you can go to the next chart of the other way of doing risk, is how diversified you are amongst sectors and market capitalizations and such. And that's why, right now we're taking on a lot of risk with this building of having 35% exposure into one space. And it doesn't feel good on a day where that space is getting hit, but we're doing this all with a couple individual stocks and then some ETFs, and they all have relatively low ATRs. So we didn't go with a nail. If we went with a nail, we would have had to dial this back. And nail being a triple version of an ITB, we would have had to dial this back to 25 or maybe 20% exposure. So all these things, nothing happens on SwingTrader by accident. It's all well thought out. Doesn't mean it's always going to have a good outcome. I wish, but nothing is by accident. If you see us do something, there's thought behind it. And that's why we have these to try to explain them. I wish we could explain every trade, but I would hope that people go and look and see, okay, they've got some software, with the way what's happening after hours. I wish we had more software. We have some China exposure, just have some diversification there with, BABA and things were looking like they were working out. We have some chips, but not too much because they are very volatile. So it's great when they're moving up, but if you have too much chip exposure, when they have those bad days, then you could end up really hurting yourself. So it's really about trying to balance things out. And I like having ETFs in the account to have your built-in diversification, but it's always in the back of your mind is a source of funds. Meaning if you see a stock that is set up and has a really good entry, you can sell that ETF to buy the individual stock and then keep the same invested exposure, if that makes sense.
Mm-hmm. Absolutely. Okay, so just to kind of close out, I want to just go over a couple charts as a reminder, and I'm just going to go back to this real quick. As a reminder, we did have our portfolio ATR way up there on the 4th of September. This is the 4th of September, and then as great as the day was on September 5th with that jobs report and the reaction to it, we were coming down considerably there. So one of the stocks that we were trimming a lot of things, and some of that was absolutely just taking some profits, taking some of our gains off the table. And we can look at A-Lab because you mentioned how it it's sometimes painful to look at, like, oh, this is doing so well. And the position is a little bit smaller. It's a half size position. So we're still in there with, over a 5%, but talk a little bit about the kind of idea behind taking some off the table.
Yeah. So I have a position in this as well.
Oh, and I do have a position in this as well.
And I'm looking at, let's go to a weekly on this. I'm looking at it as a high type flag. that you have your flagpole, and then you've gone sideways, and you had your flag. It's not a classic high tide flag, but I think there are a lot of high tide flags out there right now, and that's just because of the way the market has come up. So patterns are always, are almost always dictated by what the general market is doing and what sectors are doing. So you have a lot of high tide flags out there, but a lot of them aren't truly quality high tide flags because the flag portion might still have a lot of overhead in there. This one is more classic looking to me than any of the other ones that are liquid. So I think this one has a long way to go. So I'm trying to figure out how we can get back to a full size position from our half. Let's go back to the daily. Because even though this is SwingTrader, we reserve the right to hold, turn things into position trades. And so this one has all the hallmarks of a potential position trade. So we're looking to see where can we increase this. Now there's possibility that we have to do it a little different than normal. Normally we go from a half to a full. We might have to go from a half to 3/4 and then to a full, because it might not give us that perfect chance to double up the size. But yeah, it was a full size position, and we wanted to lock that in to reduce our risk because it's a high ATR. And the one thing about high tide flags is they have a huge potential to increase, but a lot of them fail. And when they fail, they can get really ugly really fast. So it was a risk management thing of locking that in. I would do it over again, but it kills me that it's only 0.5%. But we did the right thing because we're not trying to be cowboys out there. We're trying to do this. I'll be a cowboy in my own personal account, but with this product, we're trying to do something that we know a lot of people are following, and really it's about risk. It's about our equity curve, and it just didn't warrant that time to have a full size position. Now we've got, the Broadcom behind us, and I have a position there as well. And this is, moving up. And so we're looking, for a way to get in there, as well as, we have the TSM that, that we went with, which I have a position in as well. So the space is looking good, and we're trying to figure out how to build this one back, the A lab back up to a full. But in a nutshell, you got to lock in some gains along the way. That's a part of swing trading. If you swing trade and only do defensive selling, in some environments you can get away with that and do really well with just defensive selling, because then you're allowing things to run more. But you do have to lock some in, and you hope to lock it in and have it be a bad one, kind of like the A lab, and have it go, God, I wish I hadn't sold it, but it was the right thing to do given the portfolio. On an individual stock basis, it was doing nothing wrong. Didn't have to be trimmed. So if you're following SwingTrader and you see something and it's on there and we're reducing it, you don't have to reduce it. You can look at it and go, okay, those guys are probably reducing because they're trying to manage risk. And if you're comfortable with the risk, maybe even increase it. Do your own trades. We're just trying to have an educational product that just shows a style of trading. If you're position trading that A lab, man, you would be adding to it, not trimming it. So it just really depends on how you're looking at it.
Yeah. And look, remember that if you do more defensive selling, for instance, using moving average lines, a break below them, there's no free lunch, right? It's always a balancing act. So you're probably going to have larger drawdowns when you do that, as opposed to when you sell into strength, you might not capture the entire gain of the move, but you're generally going to reduce your drawdowns because of that. And what happens a lot of times is you find that naturally by selling into strength, when the setups dry up and you're like, oh, I can't find anything to move my money into again, it keeps you out of some real trouble. That happened to us in February of 2020. We sidestepped a lot of the COVID because we were looking, and Mike kept on saying, I'm only looking for A+ setups, and there weren't any. And so that kind of happened again this time around, February of 2025, 5 years later, and we kind of ran out of setups, and that kept us out of a lot of trouble in March and April. So I think the worst drawdown that we've had during that March and April time period was 4% off of our high. So that's something that you can come back from very easily. You start getting into 10%, 15%, 20% off your high, that hurts, and the numbers start working against you in terms of how much you have to get back to even. So again, just as an example, you let it go down 25%. It's not 25% to get back to even, it's 33%, and it just gets worse from there. So one other thing I want to make sure we get in here, because we did advertise in our tweet Palantir technology. So pretty tight action here on the 50-day moving average line, and I did pick some of this up myself today after the restriction period. So talk a little bit about what looked interesting to you on Palantir.
Yeah, I was going to buy it in my own account. And then, as I do often, many of the things that we put on, I have to, I already have, and I'm like, okay, this looks good for SwingTrader. And then I just sell it in my own account and then put it on and then wait 30 minutes. And that was what was going on here. I was about ready to buy it, and I said, no, this is in position for SwingTrader. Do I think it's a great setup? No, but what it has going for it is a clean exit. So you're moving back above your 21-day after tightening up, finding support at and around the 50-day. And so, but the 21-day was the clear ceiling, right? The area of resistance there. And when it started, getting ready to poke above it, that was a good entry. Because now our exit is really yesterday's low, which is right around the 50 days. So you know that where you're wrong. Now, I'm a little disappointed with after hours trading on this is just barely up, and you would think, because I'm seeing a lot of things up a lot, that it would have been.
And a lot of that is probably tied to Oracle. Oracle exactly. Earnings right now up 26%. So. Yeah. And so with the Palantir, a lot of the point of talking about it today was it's not always what's the best stock, which I think, this is one of the best stocks out in the market. It's not always the best setup, it's the best exit strategy. And that's what this one has going for it. It tightened up substantially over the last two weeks, gave you a clear sign of where you would be wrong by putting this swing trade on here. Now, if you're position trading this and you bought it today, I'd give it a couple extra days and let it go to that low from 2 days ago that's right underneath 150. Let it wiggle around a little bit more. But from swing trading, unless we get a gap down on it or something, we're not going to give it that much extra space. And I've been saying this from when after the follow through in April, is that I thought this was the leader in the space. Now, it's acted well, but it hasn't acted as much like the leader as some of the other things. And so there's the potential that A-Lab is the leader now. But that always rotates, and you just keep an open mind. And so that's the whole point. Whatever you're trading, whether you're trading, the things that we've got on SwingTrader or anything else, always know your exit before you buy the stock and how far away is that. Look at your portfolio ATR risk. Look at your equity curve. Does it make sense taking on that risk? And in this case, we had the chips to spend, even though it's not a perfect setup, to give it a shot. Yeah. Well, you know what? We went a little long on this one, but hopefully this is something that helped everyone kind of get it. What's that?
I blame you.
Yeah. I'm a chatty Cathy. So, so that's going to wrap it up for us this week, this month. We will definitely be back. Usually it's the second Tuesday of every month, unless we've got vacations or something like that we're trying to work around or other things. But you can expect us on the second Tuesday of every month. We hope to see you next month. And also we hope to see you on September 18th, shortly after the close. We'll be having our webinar on swing trading, kind of doing a little bit more of that beginner's approach to help people understand exactly what we're trying to do. We'll go over some of the concepts that we talked about, but in a very, very high level way to kind of introduce people to the concepts and a little introduction to the product as well. And as I mentioned, we would also be taking questions. So that's going to be Webby and I, joining you on that Thursday. So if you didn't get enough of us this time around, plus don't forget, you can always catch Webby on IBD Live. He is on there regularly, a few times a week. So you can go to investors.com/IBD Live for more information on that. And then also we have our Stock Market Today videos. Webby is generally featured on Fridays. Not this Friday. I think it's going to be Ed and I this Friday, but that's another place to kind of get more thoughts from Mike Webster. So thank you, Mike. And we will catch you later. And thank you, everybody, for watching. We'll see you next time.